Welcome, everybody, to another week of Wealth Wisdom, where we're helping you build wealth and legacy.
Companies are like an organism trying to survive.
It's always a risk when you're investing in a company that's purely tied to someone's brand.
45% of Americans have gone into debt for a Disney trip. All right, welcome back to another episode of Wealth Wisdom. We are fired up, ready to go. It's midweek into January, or halfway through January already. Time is flying. We're going to kick off this episode with a bunch of news headlines. Yesterday, market ripped. Eric, just give us a brief synopsis on what's going on. Why were markets loving the CPI report yesterday?
I feel like the market had been pricing in, interest rates coming down in the coming year for about all of 2024 up until the end of the year, right? And then we saw a pullback when people became concerned that, specifically with the jobs report, right? Jobs came in and unemployment was still at historic lows. So people are worried, the Fed might even have to raise rates, right? Then inflation numbers came in. So 12-month inflation came in around 2.9%, which was in line with forecasts. Core CPI came in at 3.2%. which was 0.1% under what expectations were. And then the other positive was shelter prices, which rose only 0.3%. So, that kind of quelled some fears. And we saw like the NASDAQ was up like 2.5%, Russell 2000, 3%. So we saw a nice recovery in the stock market there.
Right. Yeah, it was really interesting. I think technically inflation was slightly up as a whole, but it was like the core CPI numbers that were the big, caused the big winning streak. And, it basically took all talks of a rate hike off the table is what, I read into it.
Yeah, because previously, right, like the inflation numbers had actually popped a little bit. So
yeah,
we had a couple, a couple of those in a row. That's where you can start to worry a little bit, So
yeah, absolutely. And I think it also, points to a lot of optimism in the market. Even just, we're talking about a tenth of a percentage point, coming under expectations. And that caused everything to fly yesterday. So it was a good day in the market. Bill, any other takeaways there from you, your stance on things?
No, I was glad to see that didn't, go up, because that again, you strapped together a couple of months in a row of, of more than greater than expectations, right? That's when, stuff can snowball, especially in today's media and everything like that. So it was good to see that happening and good to kind of see the markets get back on the right track. Because it's funny, like, I think we were talking with a group the other day, and he was a CPA. He was just saying how he's like, geez, all these things look like good things to me, and we're seeing all these problems. And this is a guy who doesn't, maybe not as active, an active investor or anything like that. But he was just like, he's like, this looks good. Do you know what I mean? These things look good, and we're watching the market just kind of get beat up a little bit. So it was good to.
I think he was talking about the jobs report, right?
Yeah. Yeah. Right.
Yeah.
Stuff that you think would be good for the market. And that's why, we always talk about how inefficient the market is in the short term, right? Sometimes good news doesn't necessarily replicate investment returns. You know what I mean? And, but over time, right, if those good news or those good events outweigh the bad things, you're going to see growth in your portfolio, and hopefully we're going to be on the right track, right, at this point. So.
For sure.
It seemed like all the good news had been priced in the whole year when the S&P 500 rallies like 30 to 40%. And then the first sign of like any change in that good news, we saw a dip towards the end of the year. But if you can keep, jobs, at unemployment at a historic low while bringing down inflation and then in turn bringing down interest rates over time, then the Fed's doing their job. So
hopefully we're going to keep keeping them steady, right?
On
just
trend.
So that it's in line. That's the thing is, I feel like businesses and people, it's those fluctuation in interest rates, right? That kind of scare people, right? So if
Yeah.
you keep it in line so that people can operate, kind of as a business doing as, that's always helpful for whether you're a consumer or whether you're a business. Either way, right? It's those changes in interest rates that really cause the ripple effect, you know what I mean, at the market. So,
Yeah.
Oh, absolutely. Yeah. And it is, to me, it was interesting. Like, there was no Santa Claus rally. There was, things were, maybe a possible rate hike. Markets didn't like either of those things. For me, it was kind of a takeaway, kind of highlighting why, our role as, financial coach is so important. Or really, you guys are talking to clients every day. Like the emotions of, like, as the market's going down, maybe those bears who are like, hey, like, this is it, this is the time, start to creep in. And Bill, what you just said is so true. Like, that the market inefficiency in the short term, being well prepared, and if you do need money out at this moment, not to ruin your portfolio. I don't know if I'm saying that correctly, but if you know what I mean. Most people want to sell when things are going down and buy when things are going up. And it's the complete opposite of what
it
you
was
should be
all
doing.
done, right?
Exactly. Yeah. The next thing, what another interesting, last week we had Jensen Huang come out and say, hey, quantum's not happening for another 10 years. Stocks took a huge dive, at least quantum stocks. One man comes out and says this and everything takes a dive. If you're investing in quantum stocks, you probably already know that. So that's the interesting piece there. But then yesterday, or this week, Microsoft came out and said, hey, that's not true. This 2025 is the year. And those stocks rebounded. Bill, what were you surprised by anything there, or
No, I mean, keep in mind, they had a massive run up, you know what I mean, over the past 6 to 8 months anyway. So a lot of those stocks were up hundreds of percent, right? So you mean more than, double, triple, quadrupled in value, right? You know what I mean? So to have a big pullback on something that is, somewhat speculative, right? You know what I mean? I know it's going to happen at some point, but, when that happens, because I mean, I think he was even saying like 20 years is really where he thought it would have like the bigger impact, so when you're looking at something that far out, a technology that we know is going to be there, but is that far out before you actually see actual profits, right? You know what I mean? Surprising to see, after it's gone up 200, 300, 400%, you know what I mean? And then also having a 40% pullback. But then, I mean, if you just saw one of the bigger players, right, 48% a day, you know what I mean, coming right back. So I'm not surprised to see a pullback, you know what I mean, in that sense, in something that is, I don't want to say speculative, but is so, to see the profits from it coming so far down the line. Obviously, Google's come out too with some news on how they're, having some breakthroughs on their end. I almost feel like it's probably not as far, it's not as far out as they're speculating, right? You know what I mean? I feel like the way tech seems to move is, they're probably, I mean, I wouldn't be surprised if maybe in like 6, 7, 8 years, right, we start to see some really big things on it. So just with the speed of the way things seem to be going these days, and obviously with the advancements in AI and, you know what I mean, all those, taking that thing into an account. I was actually just reading something, I mean, talking about how AI is, I mean, it might even start replacing like mid-level engineers. You know what I mean? Things like
that was Zuckerberg.
Yeah, so it's kind of crazy
talking about Meta.
to think, you know what I mean, what the spiral, that snowball effect can happen, once all that stuff gets going. So and they put a lot of money behind it. So
it's fascinating to watch. I think all new technology is a little more volatile than as it's being developed, and people hear things, and I think that's what we saw with Microsoft coming out today, and Jensen saying what he said last week. So, Eric, any other thoughts there?
No, just that, hey, everyone's hanging on to every little word these CEOs are saying, and a lot of it too was what we were talking about at the beginning. Overall, what's the economy doing? And obviously these quantum computing stocks are really risky, and with the news that came out recently about inflation data, people were pouring more money into risky stocks literally yesterday. So that could be part of the rally as well.
Yeah. Yeah, good point.
But I think a good play in the quantum is having a company like Google, you know what I mean, who is still heavily involved in it, but also has these other business outlets,
Sure.
you know what I mean, that are still doing. So I think that, that's a holding of ours, and we feel like that's a good way to get in, you know what I mean, still have exposure to it. Well, maybe being a little safer than some of these small, you know what I mean, some of these smaller quantum computing plays.
Absolutely.
And so that's something that we're doing as a firm to make sure that we have exposure for our clients, but kind of doing it in maybe a little more safer manner than some of these other ones, or at least not quite, you know what I mean, quite as much risk on the table for most of our clients anyway.
Yeah, absolutely. And then there's the risk that you don't even foresee, which happened this week, or really last week, I think, or the few weeks past, with Park City's mismanagement of the entire, I mean, all their lifties, ski patrols, they all went on strike during their one of their highest, most busiest times of the year during the holidays. So, I mean, it was over a $2 per hour increase. I think it's just incredible. People, the lift lines, and they were also getting dumped with snow. Like tons of snow is falling at this time. And they were only operating at 20% of their capacity across the mountain. People are furious.
So what did they do? They were just, because they didn't have enough staff, they didn't open up as much of the mountain because they couldn't have like safe coverage, basically.
They weren't even selling lift tickets for that day. They were only honoring like pre-existing lift tickets had you bought prior. So imagine like you're spending all this money to go out to Park City for the holidays. You go to the resort and you can't ski, or you're waiting in hour lines. People on social media were reporting they were just hiking up the mountain.
Oh, the lines were
That's crazy.
Absolutely ridiculous. I mean, I've never seen, you know what I mean? Like the panning out on the cell phones, you know what I mean? You're just showing like a massive crowd for like as far as, you know what I mean, as far as you could see. It just looked, I mean, nothing worse too when you're skiing is sitting in long lines, right? You always try to dip into the other, like, dip into the whenever chairlift, right, is kind of open. It's like, nope, let's just go over there, get back up there. And to see something like that where you're just sitting there, kind of just pushing along, that's the absolute worst if you're a skier.
Yeah, no, it's awful. And then I think, people I saw videos on social of people who had fallen down, and no one is there to come help them. They were sitting there, lying there, for hours because they just didn't have the staff to go, the medical staff, right? The ski patrol.
Yeah,
so it really highlights, I mean, these are $1 billion. I mean, it's owned by Vela Resorts. It's a $1 billion company. The CEO makes all in like $6 million a year. But it is like the lifeblood of they rest on these hourly workers. It's just incredible to see.
Oh yeah, and what did they say? It was something over $1 million in wages, you know what I mean, or 900,000 in wages is what it would come out to over the course of the year.
Yeah, and I wonder what the total loss is for that closure too. Like, obviously stock price declined, they lost revenue, and it's a service industry, right? A luxury industry. And now you've probably lost repeat customers, right? So it's a massive loss.
Yeah, a lot of bad pub, right? A lot of bad pub right there. So,
yep.
From a branding perspective, it's a tough hit for sure. And a lot of people, it highlight. Social media is such a viral, massive voice that companies have to navigate these days, and so. It's a big hit over the long term. And a lot of people have kind of, if you didn't already know, the U.S. ski market is a duopoly, basically, with 90% of the resorts.
Right? But there's, most of them are owned by, what's the other company? It's slipping my mind.
Yeah, it's Altera Mountain Company.
Yeah, so.
And that's, I discovered that last year. I went to Loon Mountain as a family of 5 and went to the window, being an idiot, because I had promised everyone we're skiing today. Went to the window, $600 later for one day of skiing. So, you're kind of forced into buying one of the two passes, Icon or Epic Pass, which.
Yeah, or buy ahead. Like a lot of times you can go online, buy the ticket ahead of time. That will save you a considerable amount of money as well. Yeah. If like you're a family who's only going to go for a couple of days out of the year, you know what I mean? You're not going to quite hit the pass level. right? Maybe you don't get those days and days and days of skiing. I know kids with sports and stuff like that, it's tough to get away.
Very hard.
A lot of winter sports, hockey, basketball. I mean, even these days you got soccer and all these, other things are being played all winter. So it's kind of tough for a lot of families to get away to ski just due to timing and things along those lines. So if you're only getting those couple days, right, you really got to be planning out, October, November, buying that ticket, in advance for that, January 28th day, or, whatever day you're going. And it, saves you a considerable amount of money, right? You could be, it's hundreds of dollars, right? You know what I mean? By paying for it in advance, right? Because you're going to shave off 30, 40, 50 bucks per ticket, unless you go with the pass, right? So yeah, that's if you're a skiing family, right? You're doing it a lot, then it's really worth it. So.
Do you guys think that these prices, like the rising prices in the US for skiing, are because of the duopoly issue? Do you think it's a change in their business model instead, or maybe a change in, the wealth gap in the US to luxury sport? Maybe they're just trying to focus on hiring clientele and that's it. Maybe they only want you to do the annual pass, so they charge a massive premium for people coming in on one day. It was trending this past year I think it was on TikTok. Someone was like, hey, why am I going to Utah or Colorado to ski? I can go to Switzerland right now. It's $70 a day to ski on the mountain versus like $260 at Vail. The flights were pretty similar and lodging ended up being cheaper too. So yeah, the question is this duopoly really hurting, the consumer?
I think it's similar to a PE company, right? And how they operate. Like they bought them over the past, Bill, how many years? I mean, I think it's like 10, 15 years they've just been buying mountains.
Mm.
Yeah. I mean, it's tough for them. I think what was happening is a lot of the mountains themselves were probably mismanaged a little bit, right? So they were kind of ripe for, some of these companies who are kind of operating, like you said, in like a private equity sense, where they're like, oh, let's buy these up. Let's, try to run them a little bit more efficiently, a little more lean. And if we do have like a bad year, snowfall or something like that, we can kind of withstand some of those losses a little bit better than kind of a small company, would.
Yeah.
So
Yeah.
that's what they've been doing. But, they're taking advantage of people who, the last minute, you know what I mean? Like, so if you plan it out, it can be a little more affordable. But yeah, if you're coming to the window on the day of, you're definitely paying through the nose, so that's where you really, it's all about planning, I think, to make skiing more affordable. But if you're coming in last minute and you say, hey, I just, we booked something, or we didn't think to get the tickets, or you thought that it was best to go up to the window day of, you just get croaked, you know what I mean, with the pass. And what are you going to do? You're going to tell your family, oh, we're here, we're going to go skiing, and the difference of this much money is, you know what I mean? So no, you end up sucking it up, paying it, even though you probably, probably, busting the budget up a little bit that month or that quarter, but end up just doing it, right? So I think if you are going to ski, make sure you're planning ahead, looking at the pass options, looking at the prepayment options, things like that. It can a huge difference for you.
Yeah, and there's other ways to save money too. I think this plays well into our next topic, the main topic of the show. But it's there's ways to buy used goods, right? Like used ski gear for the kids, especially when they're growing so fast. There's places like local to us, Play It Against Sports, right? You can trade gear in every season. There's lease programs. So if your kids, if you want to go skiing, I'm not sure it's cut off to you. I think it's just a matter of budgeting, which
And just to give you a number too, so I was going to go to Park City, but my leg playing hockey, so I won't be doing any skiing this year. But I got a 3-day Epic Pass, to go out there in a cost of about $100 a day. You know what I mean? Is what it came up for me. So, or maybe it was 2 days, I forget. So maybe it was $150. But like compared to the $288 that you'd be paying, you know what I mean? If you walked up, or $300. So that gives you an idea of how much money you can't save with the proper planning. So it's definitely
huge.
Definitely a sport that you need to.
And I think it's better for the kids.
Yeah.
For the kids too. Like I think the pass is $300 a year for the whole season, and so you can.
And that's every mountain in the U.S. that's on it.
No, so that's again, right? It's the duopoly. So you've got Epic Pass is one you can buy, and then the
No,
Icon
that's what I'm
Pass
saying
is the
though. Any
second one.
bail
So yeah,
round, right?
so Vail owns Epic Pass, and then Altera owns Icon Pass. So you kind of like decide which mountains you want to go to.
Yeah.
But it is, yeah. I mean, it was a no-brainer, right? So like, if we go 2 days, we make our money back. So I think it's just getting smart. You know, it's forcing consumers who want to ski and put in their budget to say, okay, like let's make this happen.
Yeah.
You
Like
know,
young
so-
Christian's giving
I know.
Eric some trouble over there.
Yeah. So yeah, so I think that's it. But like talking about budgeting and moving into our next, like, retirement is a goal for most Americans. There's some surprising facts I want to read to you guys, but like it is, I think that the goal is always a comfortable retirement, and I want to hear both of your thoughts on that. Eric, as soon as he comes in, he can join the conversation again. But Bill, I didn't even know if you knew this. This is crazy. I was pulling stats yesterday. A third of all Americans have zero retirement savings at all. And then most average Americans, they don't even start until they're 32 to even think about retirement. So just those two stats. And the other one just like kind of that plays into both of those is like only a quarter of Americans today have even calculated how much money they will need for retirement. So is that something you've seen across your career? Like, does that surprise you at all, those stats?
Does that surprise me? No, not at all. I'm always amazed how certain people get by on certain amounts of money, right? You know what I mean? I think some people are better at it than others, right? How they've adapted their lifestyle. But there's a number of people who just, they leave a job, they immediately just cash out their 401, right? They you know what I mean? Things
Okay.
like that.
Yeah.
They, I need that money. I want to get my hands on it. And they kind of just treat it as a piggy bank, right? And what they don't realize is that they are basically sacrificing their later years. It's like, do you really want to be working? You know what I mean? Like into your 70s and, you know what I mean? Possibly later. That's going to happen, right? If you don't, you know what I mean? If you don't have savings, right? Because basically what you're doing is you're building up an asset that is then going to pay you money later on, right? So that you're building up this asset that's going to give you distributions and a payout into retirement, right? So think of it as your own business. Think of it as a rental property. Think of it as whatever you want. That retirement fund that you're building up is going to spit off profits to you in retirement. The larger that is, the bigger the payout is going to be in retirement. And that's why it's so important to start early. If you have, a lot of people, they say, how much do I do? What do I do, etc. Start with 10%, right? Take 10% of every check you make. And I would even say, like, even as, a late teen, college, you know what I mean? Things like that. Take 10%
Start as early
off
as
that
you can.
before you do anything and put it in a fund. It doesn't even necessarily need to be in your 401k, right? But try to just designate it towards retirement, right? So that money is in the market, hopefully doubling, right? Every 6 to 9 years, you know what I mean? Something like that. And the earlier you start, the more times that money is going to double, right?
Compounding.
So,
Yeah.
if you can do that with that compounding growth, we could show you study after study after study, right? This person saved this much money from the ages of 22 to 32 and then stopped, right? You know what I mean? And they have more money than the person who was just putting a ton of money, you know what I mean, away from the ages of like 40 up, you know what I mean? Or something like that. And it's like, wow, they didn't even save anything else, you know what I mean, after that age, and they still have more money. I mean, it really is, there's all sorts of quotes about compounding interest. I don't know which ones are true or something like that, but it's an amazing thing. So the earlier you can do it, the better. But I would say start with 10%. As a general rule of thumb, start with 10%. Make sure that's being saved out of every paycheck. You're paying yourself, right? You know what I mean? This is like so important. It's going to be such a difference. And I know people have a lot of bills starting out. You got loans, you know what I mean? But you really need to change your lifestyle to adapt to that. You know what I mean? So it's like, all right, like these are my bills. That's a bill. You know what I mean? It's more, it's more important than anything, right? So that's the thing. start by saving 10%. And like I said, if you want flexibility, do it outside of a retirement fund. You can start a brokerage account. Your brokerage, your IRA, your 401k can all be invested very similarly, right? It's not like, oh, in an IRA, you get more things to invest in. That's not the case. You can have a brokerage account that you could potentially have access to, but I would put away 10% of your money into that, right? I mean, ideally you want to have some that's designated towards retirement and obviously be able to take advantage of the tax, right, things that happen within these tax accounts, whether it's tax deferral or potential tax-free in retirement. You know what I mean? If you want to use more of a traditional and or Roth. But that's, you know what I mean? That's where you want to, you know what I mean? You want to be take advantage of that, making sure you're taking care of your future self, right? So.
Oh, for sure. Yeah. And I think there's also I think it takes a lot of discipline to, you can automate, like a $500, transfer, from your paycheck into a savings account to transfer into a Schwab account or whatever, and just make those consistent payments into your portfolio. But if you're living beyond your means, it's easy to say, nope, give me that $500 back this month. I'm going out to do something fun. Just to me, highlights sticking to the plan. The other piece I was, I think Tim Ferriss talked about this in his 4-Hour Work Week, and he talks about it's in a totally different context, but controlling your W's, and that's always stuck with me throughout my life, is being able to do what you want, whenever you want, with whom you want, for whatever price, really, like controlling your W's. And to me, that's freedom, and then a comfortable retirement, right? That's, to me, should be the goal at all times. Eric, what are you thinking as you're holding?
I mean, some of our best clients, they think about it. You can think about it this way, right? Like savings important. We can control how much we save, before we get to retirement, right? Controlling what we spend is even more critical, right? And some of our best clients are the ones who've saved the most money are blue collar people who simply they don't need to have a country club, up in New England and one in Florida. They don't need to have a vacation home. They're going to buy, a Kia or a Toyota instead of a Porsche. Just all those things add up over your whole life. We can't control what the stock market does, but the two things we can control is how much we save over time and what we end up spending our money on. And it's really about having discipline and delaying gratification and all that stuff. So that rings true, right? I can't remember what all the W's are, but it's all about discipline and controlling what you can control. And it leads to tons of freedom elsewhere in your life.
Yeah, for sure. I just think too that if you do the savings first and adjust your lifestyle, you know what I mean, to that, it's all right to be a little frivolous. You know what I mean? At times, if you've done the front end work, right? You know what I mean? Doing that on the front end and then being, maybe then, you can do some frivolous spending and something like that, right? I mean, we all do it every now and again. It just makes, when you've automated it and made sure that you've paid yourself first and taken care of those future liabilities, that makes all the difference in the world, right? And then it allows you that when you do it, you don't feel as guilty or, you know what I mean? It's not as devastating where it's I put off saving for retirement this year because I did, whatever, right? I went on this vacation, like that. It's all, you're going to reach your goals because you've already done it. You know what I mean? In advance, and it's you've adjusted your life, and it's much easier to adjust your lifestyle from that as opposed to going the other way, right? Where you're spending and say, oh, I need to start saving. You know what I mean? So now I need to change everything I do. You've already kind of settled into maybe a mortgage of some type. You've already settled it. You know what I mean? Your utility bills, your insurances, right? It's all gone into your lifestyle of what you've designed. And then you say, oh, now I gotta add an expense, right? Which is, the expense is your retirement. No, it's easier to have your retirement set up first and then design your lifestyle around, you know what I mean? Around that. Yeah. So that way you're in a much better position in terms of, what your regular costs are. And it's just, it's the comfort level, the easements, you know what I mean, of your life. It's done in a much better manner by doing it that way, as opposed to trying to reverse, you know what I mean, that reverse process. So
Yeah, especially when you're young and single, like fresh out of college or while you're in college, you're saving, because it's so much easier to live way below your means at that point, because it's just you. And then compared to when you're, much older or whenever, and you have a full family of, now you're sacrificing their comforts, their joys, what they're used to. It must be much harder to do that if you haven't done the work up front. And then this is like a, for everyone listening, if you're young or if you're listening and you have, younger people, maybe share this right now and let them dial into 30 minutes in the episode. But it is really important to start early to take advantage of that compounding. It's huge. Eric, any like major tips that people listening? I also think, like, if you're listening and you're older, it's still not the end of the world. There are ways to get smart, to live a great lifestyle, but do it smart.
Yeah. I mean, unless you set aside some time to kind of plan these things out, you're not going to get anywhere. And so I think what Bill was talking about is absolutely correct. Like, try to come up with a retirement plan. And then from there, you can adjust your expenses. Yeah, I didn't mean to sound like, it almost sounds like I'm in judgment of others. Like, oh, you're spending money on this. Yeah, dude, I buy dumb stuff all the time. But if you have that plan in place, you can justify those things, right?
Yeah.
So, yeah.
So what are so if someone is listening and they're like, hey, we're underwater, what some things that you would tell them, Bill? Like, how do we get back on track? And I know everyone's unique situation's different, but just like some generic, if there's anything you can.
Yeah, those are always like really the toughest conversations, right? Because people feel like they're kind of, like you said, like kind of drowning in expenses and stuff like that, and they haven't done that stuff on the front end, right? So that's kind of why they got in that position in the first place, and that's when and it's also too, it's probably like the most annoying way for those people. It's very annoying to then sit down, look at all their expenses, look at what their income is coming in, and seeing, what that
hard truth,
that bottom line, is. But unfortunately, when you're at that point, you're saying, geez, we keep saying being behind the eight ball, you know what I mean? That's when you really do get to put down everything, right? And come up with a cash flow statement and see where you're at. And then you got to really take a hard line on where can we, cut out, right? How do we get these credit cards paid off so that, that payment each month goes away and that can now go towards savings, so that's really where doing that cash flow statement as part of the financial plan can be a huge thing to get you right back on track. And you also have to understand you're not going to do it and solve it, right? It's going to something that may take you 18 months, 2 years, 20, 24 months, something like that in order to get back on track. Unfortunately, some people even longer than that, right? But the further you delay, the more issues you can be. I mean, it was funny. We were speaking with a client and, he's telling us he's unhappy with his current advisor, how things are working. He has all these questions, you know what I mean? Like, he's like, oh yeah, this is exactly what I want to do. This is what I want to go over, something like that. You reach back out a couple of weeks later. Hey, how are you doing putting together the financial plan stuff? Oh, I just want to see how things are going to pan out the next few weeks. And you almost want to ask him, well, what's changed? You know what I mean? Like, you had all these things that you've been dealing with for years that have caused you an issue. You haven't done them, right? And then, like, when it comes time to do it, you say, oh yes, I'm very interested. I want to do this. They go to do it and they say, oh, I want to let things pan out over the next few weeks. It just makes zero sense to me. You know what I mean? I'm like, I hear them say that. I'm like, I don't understand what's changed. Nothing's changed, right? In the meantime, you just didn't do anything. And then you think that waiting is going to be more helpful. How is that going to help anybody? You know what I mean?
Right.
But finances, fitness, right? People want, one day, right? One day I'm going to do it, so.
Well, I think that's why it's so important to have a coach, trainer, depending on, health or fitness, or financial, right? It's hard to do it alone for a lot of people. And I think that's one of our biggest roles is, I was talking to Trish the other day and I'm like, hey, what's the number one thing people like love you for? She was like, because I'm like, basically I'm there for whatever they need, like all the time. Like I coach them through the emotions of the investments. I'm there for them for their planning. I was like, oh, so you're like a financial concierge? She's like, yeah, that's exactly it. And you're like, I was like, it's not the investment. She's like, no, it's fine. People like that. But so I found that interesting. It sounds like you're saying the same thing, Bill.
Yeah, just keeping that accountability.
Yeah.
Funny too, because I feel like we're, as investment advisors, right? We do a really good job for people, you know what I mean? Things like that. But I almost don't even want to talk about, the fact that we probably outperform most advisors, you know what I mean? But obviously, it's nice to bring that to the table to say, hey, yeah, we are, you know what I mean? We are going to put you in a good place from an investment perspective. But at the same time, these other things are worth so much
more.
like these intangible things that we can bring. Even just talking you through situations. I mean, all the time I come up with clients and they were going to do a certain, just make a certain decision. And just some small things, talking through it with them ends up saving them thousands and thousands and thousands of dollars. You know what I mean? And
which is meaningful.
Yep. So that's, you know what I mean? Again, you look at that money, what it does compounding over time, it's huge, right? It's huge for people. So
Yeah, I view it as like an offense and defense kind of thing. I don't know what you think, Eric, but like the offense is, all right, how do we get proactive and come up with a plan, stick to the plan, investments, right? Like how do we find multiple streams of income or get a raise, right? That's probably the easiest thing for most people to do is like go in and try to get a raise instead of like sticking to that hopeful like 1 to 3% raise every year, just like really pushing. And that's probably a quick bump for people, or coming up with a plan with their supervisor or boss to say, hey, how do I get more money tomorrow? But like multiple streams of income, so investment, the side of things. So that's to me the offense. Defense, is how do we, protect assets and find savings.
Yep. Hey, and it all comes down to planning, and that's really it. I don't know what else to say.
Yeah. So the biggest, what is the number one takeaway for someone, especially maybe a client, Eric, who is approaching, like they're in their 50s and they're looking for a retirement? Like how would you advise them to say, like, let's achieve a comfortable retirement for you? Any big takeaways?
I mean, everyone's number is different, right? And there's so many different factors: living expenses, life goals. What's your current asset value? What's your risk tolerance? What risk are you willing to take on in order to achieve those goals? And the only way to figure any of that out is to actually sit down and punch in the numbers and run a financial plan. So, I mean, at the end of the day, that's what we always are going to advise people, especially as they're getting towards retirement age.
Definitely, yeah. Bill, anything to add there?
Yeah, no, it's going to show what your cash flows are, right? So we're going to take into consideration what your Social Security is, what, you know what I mean, what your healthcare costs are going to be, what your living costs, liabilities, right? Whether you have them or not, right? Some people don't going into retirement. Some people do carry a mortgage, right, throughout their retirement. It's all, you know what I mean? All those things come into play. And you're going to see, hey, based off of what I have or what I need, right, to put away in that kind of, you're almost like, you're in the red zone, right? If you're looking at football, right, you're in those last 20 yards. What do I need to do to make sure that when I come in and I start drawing off my retirement accounts, where's that going to get me? You know what I mean? What is that going to get me each year in a comfortable fashion so that you don't run out of money, right? But at the same time, you're able to do the things you want to do. Because it might end up being that, hey, there's some things that you're doing while you're working that you may need to cut down on, right? Or something like that. Or maybe something that it doesn't affect you at all, but it's good to know, because if you start doing some things early in retirement that, you didn't plan for, and, a lot of people do, it's proven. Most people will spend a lot of money, a lot of money within the first few years of retirement, right? That first, like maybe 5 to 10 years. So you just want to make sure that you're in a position that you're able, you're able to do those things and not worry about the long term, right? Because if you're spending a lot of money and we do happen to have a market downturn that you need a few years of recovery, we just want to make sure that the cash flows, we've done the proper planning. You have the proper investments to support those cash flows, safety of principal, things like that in that stuff, those investments, and then stuff for later on, right, is in something that might be a little bit more volatile, but will keep up with inflation, beat inflation, and hopefully grow, right, in value so that you can have a, well into your retirement, you're in a good shape, so.
Yeah. That's it. It's excellent. I hope people take a lot away from this episode. I think it was great. As always, thanks for listening, everybody. That sums it up. That wraps it up this week. And we will see you next week.
All right.
Thanks, guys.
You go, bye.
See you next week.
Bye-bye.